Hey, everybody, and welcome back to our monthly market update. I'm Brad Gatto, owner and CEO of Fiat Wealth Management. And as always, I have Mr. Tim Holland here with me. Tim Holland is the Chief Investment Officer for Orion in Town Square. And Tim, it's always a pleasure that you give us the time to do this and do a market update. So thanks for coming, man.
Yeah, good to see you, Brad. Hope you're doing well and the team at Fiat and your clients and your family. And yeah, it's hard to believe it's September. Summer's over and football's starting and it's
Tonight, actually, as we record this, first NFL game is tonight.
There you go.
We're all good here, Tim. We're embarking on, in Minnesota anyway, our average 3 weeks of fall before winter kicks in. And I love fall. I think it's great. But I hate winter. So it's this is a great time of year.
I've been in Minnesota many times, including during the coldest days and the nicest days. And this is probably too much information, but when our son was born, he had pretty bad reflux. So I had to carry him around in a little sling like all night, wouldn't sleep. And I used to listen to a Prairie Home Companion on I think I had an iPhone. It might have been an iPod at the time. I just love listening to Garrison Keillor. I mean, he could read the phone book and he's got that great baritone.
Yeah.
And he would just talk about, Gus is pretty good grocery and, where all the women are strong and the children are above average. And I just love, anyway, I'm a big fan of the great state of Minnesota. And I know how cold it gets. So good luck up there.
Well, let's give these people something to sink their teeth into. We're just kind of reviewing the month of August. And we kind of stole the show just a tiny bit in our July review, because as we recorded it at the beginning of August, that day we had just gotten news that the U.S. debt was downgraded. And of course, that was a big factor in the outcomes in August. So I don't want to spend a lot of time on that. If you didn't get to watch our market recap last month on kind of what that meant, feel free to go back and watch. But we're going to keep moving forward. August ended up being a tough month, as we probably anticipated with that news coming out at the beginning of the month. Most major indices were down. And so, Tim, can you speak a little bit to what was going on there in the month of August?
Yeah. And as we know, right, we've been in this business for a bit. Nothing goes straight up all the time, right? Markets never go up every day, all day. It'd be a lot easier, I guess, if they did.
Right.
So, sort of 2 steps forward, 1 step back is kind of how the markets work, especially when they're healthy. You kind of digest gains. And as we sit here in early September, even with, to your point, Brett, and September hasn't been sort of great shakes yet either. The S&P is still up about 16% year to date and still north of 20% from last year. So my 2 cents is you kind of came into August with really good gains and a lot of momentum. People probably became a little too optimistic about the market. As we know, when people feel good, you should probably be a little more cautious. And when they're really scared, that's when you want to be more bullish. So people became pretty optimistic. That's usually a contrarian indicator that maybe the market's due for a pause. You had the debt downgrade, to your point, and that debt downgrade did something to the bond market or helped do something to the bond market that weighed on stocks. And that was bond yields just went up. And so when bond yields go up, 2 things happen to stocks. One, bonds look more attractive, and we think it's a great time to be invested in U.S. bonds today. So people will probably sell some stocks to buy some bonds, and higher bond yields just essentially make stocks, from a valuation perspective, less cheap or a little more expensive. So you kind of put all that together. The S&P was off 2% or so. Smaller stocks did a bit worse. Ex-US stocks did a bit worse. So not a good month, but given where we had already come in terms of the markets from January 1, some of those headlines you talked about, not all that unsurprising. And to reset the market a little bit, even though it's not fun to see stocks go down, isn't such a bad thing either.
Yeah, well, and at the end of the day, most people aren't just in equities. And so the positive side of that coin you brought up is the bond market saw that uptick. In fact, to give a little bit of perspective to that, the barometer that a lot of people like to use when it comes to interest rates is that 10-year treasury note or that 10-year government bond. And we've seen an all-time high in that 10-year bond. Well, not an all-time high, excuse me, a 16-year high. It hasn't been this high since 2007. And so that gives you a little bit of perspective on where those rates actually are and how long it's been since we've seen interest rates this high.
Yeah, for sure. And so again, you're looking at that. You run in a balanced portfolio, and to your point, your clients are in balanced portfolios. It's just a good way to mitigate risk and smooth out the return stream. And when parts of the market go on sale like that, and you can lock in 4% plus on arguably, even with the debt downgrade and all the problems our great country has, arguably the safest fixed income instrument in the world, it's hard not to lean a little bit that way. And that makes a ton of sense to us for sure.
Yeah. I'm going to put you on the spot here a little bit because we didn't rehearse this ahead of time, but it's interesting. So we talked about the 10-year US Treasury, 10-year government bond, being in that mid fours range.
Yeah.
But then if you look at the shorter term bonds, they're even higher than that. And so historically, I mean, typically you would think, okay, if I give my money to a bank and I buy a CD for 1 year, I get paid one rate. If I give my money for 5 years and buy a 5-year CD, I should get more money because I locked my money up for longer. But we've got this weird thing going on with government bonds. Can you talk a little bit about that and what that might mean?
Yeah. So if you set aside sort of the investment case for different fixed income instruments, to your point, sort of shorter term and longer term securities, you're absolutely right. It doesn't make sense that you would get paid more on a short term loan than a long term loan because your capital is not locked up for as long. You don't run as much inflation risk, default risk, all that. So setting aside sort of the investment dynamics, the bond market is telling us that the economy, even though it's still really strong and surprised to the upside in Q2, is likely headed for a recession. Whenever those yields on those shorter term instruments that the government issues are higher than yields on the longer term instruments, typically within a year to 18 months, once that goofy dynamic starts, the economy goes into recession. And to kind of stick to the loan or the lending or the banking analogy, no one's really sure why that's a sort of a harbinger of a recession, what's known as an inverted yield curve, where the yields just kind of don't make sense. But the way I like to think about it is if you're a bank, I think about the yield curve the way I think about a bank. So on the short end, if I go into a local Wells Fargo branch and I deposit my money, the bank's going to pay me a certain amount of interest for using those funds. But if the bank's then going to make a long dated loan and the yield on that loan is lower than is less than what they have to pay me for my deposits, it doesn't make any sense. They're not going to issue any loans. Credit's going to dry up. The banking system just won't provide the liquidity that the economy needs. So no one's really sure why it's been such a reliable sign of recession, but it's one of the reasons why, even though I don't think we're going into a bad downturn, I think there's a good chance the economy could weaken at some point in 2024.
Okay. I don't want to be that guy that just like lets you say that. Like, well,
I know.
Bad recession, then leave that there and not touch on it. There's going to be a point. We've got a couple more points I want to make before we get to the end of this. And I think we'll come back to that in this third point. But before we get to that third point, let me stop on the second one, which is September. We're now in the month of September. And historically, September is not a good month when you just look at the markets. And I'm not saying there's a rhyme or reason to this because I actually don't really know or understand. And so can you just talk about the history of the month of September in the markets and maybe a little clarification, if you could, even on why September tends to be a great month?
Yeah, and I'm not sure why either, right? The math is pretty obvious in that, or pretty straightforward. Since 1928, the S&P 500 has produced an average annual return in September of negative 1.1%. It's going back that far. It's the only negative month out of 12, and it's by far, it's a meaningful pullback, and no one's really sure why. But September's tough. I mean, not to stay in sort of the scary part of the sort of library in terms of market history. October gets all the headlines, right? 1929, 1987, but September's the rougher month for sure. And there's no real good reason as to why. So August, September, and October are part of a seasonally weak part of the market. October tends to be up. August was obviously down. When you get to November, you're in the seasonally strong part of the market. November, December, January, February, March, April. So we wouldn't, we try not to lean too much on just market history or the calendar, but history tells you a little more weakness this month. Wouldn't be unexpected. Again, we keep in mind that we're up 16% on the S&P. Nothing goes up every day
Yep.
or all day. But yeah, you're right. September's been a tricky month for the market. So a little bit of weakness here wouldn't be unexpected.
Well, a couple of things I want to add to that. Number one, if you're in equities and you're looking at this and going, gosh, if September's that bad of a month, should it be moving out? Well, if you're in equities, it shouldn't be for the month of September or for the month of December or just until the end of 2024. Equities are typically a long-term play. And a lot of times here at Fiat, if it's not 10 years, we have a hard time with, unless it's income. But if I'm looking for price appreciation out of a stock and I want to invest and not gamble, I mean, you're 5 years minimum, more like 10 years. But a lot of times we're still using equities for income because the dividends are good, things like that. Bottom line is timing the market's not a good idea, even if you know historically September's a bad month. I just think it's an interesting stat. Number two is keep in mind the opportunity that we just talked about. So yes, we mentioned a couple negative things, but at the end of the day, every time something loses, something else gains, right? Money doesn't just disappear. And so some of the money that's disappearing out of the equities markets is reappearing inside of the fixed income markets or the bond markets because there's opportunity there, which actually, Tim, to this day, it feels weird for me to say because I've been in this industry this is my 18th year. I've never been excited about bonds.
No.
Never.
We were having this, our investment team was having this conversation, and it was along the lines of in the last 20 some odd years, it's been really, really hard to get fired up about traditional. And I know bonds should be boring, right? Bonds are about preserving capital, keeping capital intact, earning some income. You know, that's your safe money. Stocks, a little more risk, but greater return. To Brad's point, that's where you get real wealth appreciation. But we were having the same. It's funny. 2 days ago, we were saying it's been 20 plus years, and the last 10 or 12 years before this stretch, particularly, there was nothing on offer in the fixed income market. So, you know, it's been bumpy to see yields move up. People are still worried about inflation. I get it, but I think it's kind of it's a good thing that yields have normalized. That the Fed's, and I know it's been painful for a lot of people. I remember, and I'm sure you do too, during the teens, the idea was we're never going to be able to raise rates. We'll never have any inflation. Not that I want too much inflation, and yields will never move higher. And that environment wasn't healthy. Everything was too much on one side of the ship. So I think as bumpy as it's been, the Fed being able to get rates to 5% and the U.S. 10-year at 4 and change, I think is actually a healthy thing, and it brings more equilibrium to the market for sure.
Yeah, really good perspective, actually, because when we were in the middle of that in the teens, the only really good example that people kept pointing to was Japan, who got stuck at zero forever, and they couldn't off. And they're like, we've never seen anybody able to bounce back from these 0% rates, and here we stand. And here I am trying to convince people that broccoli tastes like ice cream, but it's just true. It's the boring part of your plate, but man, does it taste good right now. So
and you get older, you need to eat more broccoli. Right? You gotta take care of yourself. So anyway,
one last quick point before I let you go, if you don't mind, Tim, and that's this Jolt's report that came out, and I want you to define it because people probably don't even know what in the world that is. The average person, I forget what it is from time to time. Talk about what the report is, what the report said, and why that's meaningful to us.
Yeah. So, and Brad and I were joking about this earlier, right? Jolt Cola, all the sugar, twice the caffeine. I mean, you had a can of that. That was like the original energy drink, I guess, right? That was.
Yes, it was.
Early.
And Surge, Jolt Cola and Surge.
Yeah, you're right. I guess they had that market and they missed it. So
they did.
So you know, talking
timing's everything. Like sometimes you're just too soon.
Yeah, no, Monster, you know,
like Black Magic. Remember that? Do you remember Black Magic, the company before the guys that left Apple and invented the smartphone before everybody was ready for the smartphone, and they failed?
Yeah.
Oh, man.
Half of life is timing. No, that's okay. So, and back to the economy and sort of thinking the economy could weaken, right? So, and I know we all know this because we lived it, but you go back 3 years, the economy gets shut down, and the federal government, the Federal Reserve pumped trillions of dollars into the economy to kind of keep stuff from just going away, kind of give everyone a big loan to sit in place so we can turn the economy back on when we're ready. And when they did that, supply chains were overwhelmed and people had all this money to spend. And so inflation went through the roof. There were some other reasons too. And there weren't enough workers because people either didn't need to work because they had this sort of COVID stimulus money, or they
Yeah.
were just scared to come back to work. And I'm not sort of passing judgment on anyone. So at one point, this JOLTS report, which stands for Job Opening Labor Turnover Survey. So I know that's a mouthful, but essentially the government on a monthly basis goes out and does its best work to figure out how many open jobs are there out there, and then how many unemployed people are there. And there's always some number of people unemployed, and there's always some open jobs, even during the best times or the worst times. So with all these people kind of stuck at home or not comfortable going back to work, at one point, the JOLTS number hit over 12 million. It was the highest ever in 2021. And there were only, and I don't mean to sort of make unemployment, 6 million people unemployed. So there were 2 open jobs for every available worker. And what that meant was companies had to compete for labor and keep raising wages. And it's great to see people get a raise, but then the Fed's worried about inflation. So the Fed's been raising rates to slow the economy, raise borrowing costs, and the labor market's been really strong. And that's been a challenge for the Fed, because the Fed doesn't want a severe recession. And I don't think we're going to get a severe recession, but the Fed's got to let all that money kind of work its way through the system, let some of the air out of the balloon without popping it. And the labor market kind of hasn't cooperated, which brings us back to Brad's point and the most recent JOLTS report, which showed 8 million job openings, the lowest in over 2 years, and again, down from 12 million. So our best guess is, because it takes a while for all those rate increases to impact real behavior, I know the economy's been strong and I don't want a recession or even a mild one, but I think the jobs market is slowing. I think it's a good thing, because it means that the Fed's winning the fight against inflation. I know prices haven't come down, but they've at least stopped going up so much year on year. And that means that it's likely, sort of knock on wood, that the Fed is close to being done raising rates. And we actually have a chance to stick what they call on Wall Street as sort of the soft landing, that you bring inflation under control, you slow the economy without a meaningful downturn. And I think the Fed's got a real shot at that. And the JOLTS report shows that you're seeing that gradual weakness in the labor market, which, again, I don't want to see anyone lose their job, but you need to see that if you're going to win the war against inflation without a bad recession. And so far, at least, I think the Fed's getting close. And that's why I think even if the economy slows, as yields come in, inflation comes in, the stock market should continue to do fine, even after a tough August and a bumpy start to September, if that makes sense.
It does. Tim, very good insights. What I want to leave people with is, as you were talking, kind of what was going through my head is how quickly we forget, right? So August was a rough month. We've started September rough. We brought up some stats that maybe correlate with that, or give some reasoning why, and maybe even give us a little bit of negative sentiment moving forward, possibly. But at the end of the day, we're in the middle of a bull market that I don't think anybody would have anticipated or guessed or thought. A year ago, I far be it from anyone to try to tell me a year ago that they would have been like, well, yeah, I knew this was coming. I knew that even after a downturn in August and September, the S&P would have been up 16%, 20% since the bottom. And so, long story short, equities continue to be a great position, but it's nice to have other options. It's finally, it's been tough for retirement planning for a lot of years, because the only meat on the bone was equities. And where else do you go? And when volatility strikes equities, it became really tough. Now we all of a sudden have additional tools that got sharpened out of the toolbox and are actually worth using again. And so we've got some other options, and it's great having a partner like you to help us build out in a meaningful way fixed income positions and things like that to take advantage of that. So excited to have this partnership at a time like this, and and as an advisor, honestly, to have more tools in my tool belt than I've had for the better part of 15 years. So all that to say, there's always positive. So everybody, thanks for tuning into the September. I can't believe it's September. I almost said the September monthly market update. Tim, you're a rock star. Thanks for being with us again. We'll be back in a month to give you another update. Tim, enjoy the rest of your evening. We'll talk soon.
You take care, Brad. Thanks.
Everybody.
Bye.